On Friday, equity markets struggled, closing in the red or lower after a relatively good week. Sentiment weakened with news expected this week on another big increase in unemployment in the US. Economists are expecting unemployment to get to 8.5% this month after expectations of another 660,000 people to have lost their jobs, meaning 5 million people have lost their jobs since this all began. The deteriorating outlook means President Barack Obama's plan to save or create 3.5 million jobs by boosting government spending and cutting taxes will still leave the country shy of pre-recession employment levels. However, with the massive extent of some of the measures underway, employment and trade, as well as financial and equity markets, must show some positive signs in time. Last week saw currency and interest rates move like we have never seen before. In the ASB trading room, traders with over 20 years experience said they have never seen anything like the movements from last week. The Kiwi dollar quickly rose to over 58 cents at one point last week, while early Monday morning it was back just under 57 cents against the US dollar. In interest rates, there was a stampede from borrowers trying to lock in favourable long-term rates last week. This meant that rates went much higher very quickly as demand forced the market higher. The 5-year wholesale interest rate moved about 0.55% in 1 week. Typically, a movement like this would occur over 1 to 2 months in an extreme upwards market. The 5-year interest rates are now already back to their average levels, which means that shorter terms may become more attractive to borrowers. After several weeks of firming beef prices, it seems that expectations are that there may be some price weakening in the US to come. The continued strength of the New Zealand dollar over the past week doesn't help matters either. The US imported beef price still remains pretty good, up on last week but just shy of its long-term average. During the trough of US prices in 2002, US prices were well below current levels at around $1 per pound versus the current price of $1.28 per pound. Packers in the US are still complaining about negative margins at present. Losses are up to $30 per head. The risk at present comes from the dairy industry and talk of a big cull of dairy cows through the middle of this year. With dairy prices falling, it seems a big kill of cows may help to reduce supplies in this industry. However, the increase on beef supply is likely to have a downwards effect on beef prices through the middle of this year.